Hello and welcome to Become a Tax Expert Almost, Compliance Made Easy with Vertex and Salesforce. Today's webinar is sponsored by Vertex and Salesforce and produced by SmartBrief. My name is Scott Becker. I'm from SmartBrief, and I'm excited to be your moderator for this special event. Now, before we get to today's great session, we have a few housekeeping items that are going to help you get the most out of it. First off, we want this to be an informative event for you, so we encourage any questions in the questions box in your webinar control panel. So not only will we have team members responding to questions during the live event, but we'll also have a dedicated Q&A session at the end of the presentation where we'll discuss in greater detail some of the top questions that you ask. A Q&A panel is also the place to let us know about any technical issues that you might be experiencing. A browser refresh will fix most audio, video, or slide advancement issues, but if that doesn't work, just let us know there in the Q&A and we'll provide further technical assistance. Now, second, in the handout section of your webinar control panel, you'll find that we're offering several resources. I'd especially like to call your attention to four of the resources there. There's a blog on maximizing efficiency with Vertex for Salesforce Revenue Cloud. There's an ebook about Salesforce manufacturing, an ebook for the Salesforce retail industry, and a video on the Vertex and Salesforce B2B Commerce Cloud integration. So I encourage you to access those resources now and feel free to share them with your friends and colleagues. Now, third, at the end of this webinar event, we will be awarding a $250 Amazon gift card to one lucky registrant. Of course, you must be in attendance during the live event to qualify for the prize. Official terms and conditions of today's prize drawing can be found in the handout section. Just scroll to the bottom and you'll find the link with the details there. Okay, with that housekeeping out of the way, let's get to today's fantastic content. So it's my pleasure to introduce you to our presenter today. We have Scott Newell, who's a Senior Partner Solution Engineer with Vertex. Scott, welcome. Thanks for being here.
Thank you very much for having me. And today is a presentation by the Scotts.
That's right. All right, well, I'll turn it over to the Scott portion of the presentation, then I'll be back for Q&A. So take it away.
Thank you, Scott. Welcome, everybody. Good morning. Depending on what part of the world you're in, good morning for me. I am here on the West Coast of the United States, and today we're going to discuss tax, and you're going to become a tax expert almost today, and how tax functions within Salesforce environments as well. So this is myself. I am a Senior Solutions Engineer at Vertex. I handle all of our relationships with Salesforce and the system integrators within the Salesforce ecosystem globally. So I'll go into some details of our connectors to Salesforce, but I handle the relationship between Vertex and Salesforce on a technical side. So hopefully there's some knowledge within this webinar that will help everybody understand more about tax. Here's today's agenda. First, going to go over an introduction. Actually, just did that. So step number one, already out of the way. Then I'm going to go over what is indirect tax. When I say indirect tax, it kind of confuses a lot of people. So I'm going to go through the details of what tax is and what we're talking about when we talk about indirect tax. Then I'll review the Vertex and Salesforce partnership, go over tax automation across the tech stack, and do a brief demo. It's a pre-recorded demo video I'm going to play for everybody here. It's about 2.5 minutes long. And then I'll review some questions. And then I will let everybody here in attendance to the webinar know how to learn more, how to get in touch with me after the webinar is over. Okay, the fun part, indirect tax. What is it? Why does it actually matter? So there's two sides to indirect tax compliance. The first is tax compliance itself. And this is with, and I'm going to be talking about just domestic US taxes today. I'm not going to be discussing VAT or GST or international taxes away from US domestic. That is a whole nother webinar in and of itself, possibly several. Same with this topic today. This is like a crash course, sales tax, US domestic indirect tax 101. And so let's get started down the list on the left. And actually, the primary, the meat of this webinar is going to be each one of these individual topics that I'll go into in more detail. First is nexus. The definition of nexus is the requirement to collect indirect taxes in a state. So an organization has subjected itself somehow to the laws of the state and is therefore required to collect taxes on behalf of that state as an unpaid agent. That's what nexus means. Second piece, sourcing, taxitis. What is it? What is situs? That's a very specific word. It's not really seen anywhere else. And so I will go over what it means, what sourcing rules are, and what taxitis is, destination, origin, and mixed sourcing rules. Customer taxability and exemption certificate management. This is the third step along the process in tax compliance. It's making sure that you know the taxability of your customer themselves and why they might be exempt from paying tax, and if they have a piece of paper to prove it. Okay, there's two different types of customer taxability and exemptions, taxability rules and exemptions. First one is entity based. Who is this business? And also usage. What are they using this purchase for? So I'll go into more depth on those. Product and service taxability. What this refers to is not the customer and who they are and if they give you a piece of paper saying that they're exempt or not. This is what that person is buying, or what that company is buying. Is that thing or that service taxable in each given state? And that changes by state, by local authority, and it can change within the state based off of the city and counties as well. Then rate application. This is the piece. Notice that this is what, 1, 2, 3, 4, 5. This is step number 5 along the journey, is the rates. And typically, this is step number 1 for a lot of people. This is what they think sales tax is, or indirect tax. It is the rate. Well, the rate is actually made up of state, county, city, special taxing jurisdictions like police precincts, schools, things like that. And there's also like metro transit authorities as well, or utilities that can have a tax, or stadium taxes. The stadiums can levy a tax as part of a sales tax or indirect tax scheme. And so the rate is actually the 5th step along the way. It's very important to get right, but all the pieces before it have to apply first. Now we get to multi-tax. And why I refer to tax compliance as indirect tax is because it's sales tax. It's also excise taxes. It is gross receipts taxes. And then there's all these other taxes that are across the United States, like a bottle tax. Depending on the size of the bottle that is being sold, whether it's 750 milliliters or whether it's 1 liter or larger, it can have an additional levy tax based off of the size of the container that holds the liquid. So there's a bottle tax or a sweetened beverage tax. This is like a sugar tax in some states. This is a tax on a tax. So the sugar content of a beverage can dictate whether there is a tax on a tax, meaning sales tax, what we typically think of as the first tax on when we buy something, is the first calculation. So if you buy $100 worth of something, you have a 10% sales tax, total is going to be $110. Well, this sweetened beverage tax is on top of the sales tax on those items in the cart as well. So a tax is a tax. How do we calculate that? Very fun. Gross receipts tax. This is actually remitted by the business on behalf of the consumers. And then we have Colorado and Minnesota delivery fee taxes. These are displayed as separate line items on a receipt, separate from sales tax. And then we have excise taxes, typical excise taxes that we think of. These are telecom, oil and gas, alcohol, what we call sin taxes, cigarette tax, tobacco tax, things like that. These are typical excise taxes. We also have some states that don't run a sales tax concept. They actually run there's one state, Hawaii, has an excise tax. It's called the GET. It's GET, General Excise Tax. That is not a sales tax. It's also an indirect tax. Acts as a sales tax, but it's actually in true nature an excise tax. So these are all of the various tax types that make up indirect tax compliance. Now, if you notice, there's some pieces that are missing. And typically when people hear, oh, tax from business, they think of corporate income taxes. They think of business taxes, right? Those typical what we think of as filing our 1040, right? Our income taxes in April, or if you get an extension later on, right? Those are direct taxes. And why I want to draw the difference between the two is because direct taxes are called that because they are directly filed between the business entity and the state or federal government. It's a direct filing. So the organization itself is directly responsible for paying those dollars in tax from their own bank accounts to the authorities. Indirect tax is actually the business acting on behalf of the buyer, collecting taxes that buyer owes the state, and then remitting on their behalf. So they're actually acting as an intermediary in the process. That's an indirect tax. Sales tax, excise taxes, bottle taxes, sweetened beverage tax, delivery fees, grocery receipts, those are all indirect because they're actually the responsibility of the buyer to remit those to the state. What states found out is that this is a very difficult process to collect tax from a buyer on a previous transaction. Nobody wants to say, hey, at the end of the year, I owe you $6,000 in sales tax for all the stuff I bought this year. That's impossible. It would be unenforceable. And so instead, the business that sells the goods is then responsible for collecting and remitting that and getting it right. And that's why this is called indirect tax. So all indirect taxes sit within, the final pieces before I jump into the right-hand side of this slide, the returns filing. So a business has to tell the states and local jurisdictions what it did, how much money it collected for each jurisdiction. And remember, the jurisdictions only care about themselves. It's natural. They want to collect the money that's due to them. And so they want to know that the business collected X dollars from its residents the right way for the amount sold. That's what the states and local jurisdictions are looking for. And that's what the point of the return is to say, hey, state authority, I sold this much. This was the average rate that I collected. Here's the money, and I did it correctly. Okay. And so that's the point of the return. I'm going to go into more depth of that. And then at the end, there's financial and audit reporting. So there's audit prep. Audits are not like the end of the world. It's just a state jurisdiction, a state or local jurisdiction checking to see that everything was done correctly, right? And they want over or under anything that is incorrect. The point of the audit is to fix that and bring it to net neutral, correct. Okay, so it could be underreported where the business would owe more. It could be overreported where the business actually collected more than they were supposed to, and they need to bring that back to the level that it should be. I'm not going to go over use tax. Use tax is another thing. That is when the buyer actually does self-assess and pay the state directly. I'm not going to discuss use tax in this webinar. It's a whole nother topic in and of itself. All right, so the right-hand side. So how do we do this? How do we manage all this stuff? Well, that's with technology. It has to be done in the transacting software that's being used to run the sale, okay? That is where indirect tax lives. It doesn't live in ledgers. Ledgers, the work has already been done. We can adjust ledgers and reconcile, but the transaction's already settled. It's already all done. So once it hits ledgers, that's too late. So the indirect tax compliance is done at the point of sale. So transaction systems typically include an ERP. That could be with a hand-created ad hoc invoice or a quote, converting an order to an invoice. Could be fulfillment of product for online purchases. Lots of different ways an ERP can be the primary transacting software for a sale. Nowadays, though, that's changing. So a lot of the invoicing or sales processes are moving out of accounting for B2B transactions and towards more of a consumer buying behavior. And now we're seeing a lot of B2B e-commerce shopping. We're seeing a lot of, OMS systems, obviously, for fulfillment, where the final billing and sales tax stamping actually occurs when the item ships out of the warehouse. But we're also seeing social. So Instagram. People are buying things on Instagram. People are buying things on TikTok and Facebook. And they're now turning into the actual transacting software. Marketplaces. Amazon is obviously the example I'll use. It's always used. It's fulfilled by Amazon or Amazon Marketplace. So they actually are the ones collecting the sales tax and then telling the business what was either collected on the business's behalf and remitted by Amazon, or Amazon kicks the funds over to the business and said, hey, we collected this amount, remit this to the States. Just depends on your relationship with the marketplace. Etsy does things differently too. So the transaction can occur in lots of different places. The important part is that they all align. They all need to calculate tax the right way and the same. Therein lies the difficulty. Typically done manually, these are tax tables, rate tables, rule sets, manually built and managed within transacting software. Salesforce, we have 10 different integrations into Salesforce. Fantastic software. It provides an amazing customization foundation to create tax tables of my dreams. I've done it before. That's why I'm in this space. I actually love tax management manually, but it can get too much sometimes. And so when tax collection is more than, say, 10 states, it just becomes very difficult to manage those tax tables and rate rule sets and flows within Salesforce systems. It becomes a lot to manage. It becomes a full-time job. Salesforce does way better than many different systems on the market. Some transacting systems don't even come with the ability to create rate tables, or they're very convoluted. So you can customize Salesforce platforms to be able to handle very complex processes. So Salesforce is a little bit easier system to manage those and at least create the tables and apply the flows to calculate tax within the system. But there comes a point where automation can enhance this process. So I'm going to go into that in a little bit as well. Then at the end, we need to maintain these tables. We need to maintain the system. So if you do use a tax engine like Vertex, somebody does need to maintain it, make sure it's calculating appropriately. And then at the end, we need to reconcile across these systems. So if the e-commerce platform shopping cart calculates tax and stamps it, it needs to be the same that what was written to the ledger to the GL in the ERP system. Okay. So, and custom determination needs unique systems sometimes. So whether that's tax engine side or the Salesforce side, that's a customization requirement that I speak to there. So some different compliance footprints need special care. Alrighty. There's a lot on that slide. Hopefully everybody is still with me. Okay, so let's dive into Nexus. These slides I'm going to kind of crank through. We are about 20 minutes into the webinar, so hopefully I can work through these within the next 10, 15 minutes or so, and then we'll all be tax experts at the end of this webinar. Nexus, what is it? Well, I said this is when there's a business and it's required to collect tax in a given state. So there's 45 tax collecting states, plus the District of Columbia, which is technically not a state, it's a territory, but it does have a sales tax of 46 tax collecting main jurisdictions across the U.S. We call the states that do not have a sales tax, or specifically a sales tax with this. Some of them have excise taxes, but the nomad states. It's New Hampshire, Oregon, Montana, Alaska, and Delaware. There's some specifics. Alaska does have locals that can enact a sales tax compliance requirement, but as a state, it does not have a sales tax. I do note that Alaska point there. It does have local jurisdictions. Hawaii has what is called the GET tax. It's GET, tax is redundant. It's part of the acronym General Excise Tax that acts like a sales tax. Well, there are two pieces that run Nexus. First is physical presence, and that was set by precedent in 1992, Quill versus North Dakota case in the Supreme Court. This established that a business needed a person, a place, or a thing, it's a noun, to be required to collect tax for that state. So they had to subject themselves to the laws of that state in some physical fashion for that state to require them to act as an unpaid agent, collect tax, and remit it to the state. Had to have an employee living there or traveling there frequently or recurring on a recurring basis, using the streets, the sidewalks, the signs, that sort of thing. If you had to lease or own an office building or a warehouse, or you had to house inventory. That was the long-standing precedent. Well, that was challenged in 2018 by Wayfair. South Dakota challenged Wayfair, wanted Wayfair to pay sales tax, collect and remit sales tax in South Dakota for its residents. Well, South Dakota won that case, and it was established that now there's an additional piece on top of physical presence, which still exists, Physical presence is the number one step. Second step is this remote seller nexus thresholds. South Dakota established that about $100,000 in revenue or 200 orders into South Dakota establishes a remote seller presence and the requirement to collect and remit sales tax on behalf of South Dakota. Typically, these two pieces apply, revenue and order count, or. They're not universal rules across the country. Each state had the ability to establish its own thresholds, so for dollar amount or order count, and whether they were in tandem or exclusive. So some states you need to have both. You need to have either one first. It depends on the state. So there's lots of resources out there. All you have to do is Google search, hey, what are the thresholds? Vertex has online resources to do that. Our accounts map it in real time. So if you're transacting with Vertex running the tax calculations, we track that for you. That is a kind of a commodity in the space at this point because it's an important thing to know. So if you are using a tax engine of some kind, typically that's tracked, or there's lots of resources out there to find out what these thresholds are. So it's not a secret out there, but what they are. So these are the triggers that then require a business to collect and remit tax across the country. All right, sourcing situs. Situs is a unique word for both nexus and situs are tax industry specific words within the indirect tax space. I'm sure they might have some meaning outside, but I like to think it's in the tax space only. So what is it? Well, this is just how do we calculate who gets the money? It's basically what this is. Sourcing, situs, who gets the money and why. If it's between two states, so interstate, it's the destination state. It's not a federal law, but it's just that's the sourcing rules for interstate transactions. It's the destination state gets the tax because that's where the resident is, and that's the state in which the business has to have nexus. And if that's the resident of that state gets the money. That one's pretty simple. That's destination sourcing rules. Okay. Origin is applied when it's in the same state. So there's less and less origin-based states these days. In fact, I don't remember them off the top of my head, which I probably should. But origin means that if I sell something within the same state, I live in Washington State up in the far upper left corner. If I ship something from where I live in Washington to a different city, Tacoma, for example, that this is not an origin state, but if it was, it would be my address is where I would calculate that tax. So all the jurisdictions would apply where I live, not where I ship it. That is an example of an origin-based state. Okay, so it's where the seller is, not the buyer within the same state. That's origin. Now we have some states that are mixed sourcing. California is a fun one. If I ship something from Los Angeles in the south to San Francisco, midway up the state, it's mixed sourcing. So obviously the state applies. But then we have the county, which is LA County, which is origin. The origin county applies. But then the destination city and the destination special taxing jurisdictions. So in that transaction from LA to San Francisco, I'm going to have California State, LA County, San Francisco City, and the San Francisco special taxing jurisdictions and metros. And I have to build that into my system. So that's how confusing sourcing rules can be, and those rates can vary widely within those jurisdictions. And also, I need to track that and report that correctly on the return and say I collected X dollars for San Francisco versus X dollars for LA County, and for all the transactions that I had for that period. Some states have home rule. So home rule states act a little different. And this basically goes back to, hey, I'm a city in Alabama, and I don't trust that the state's going to collect the money and give it to me. That's what home rule states kind of, that's what everything kind of goes back to is lack of trust when these authorities were just getting started back in the day. I don't trust the state's going to collect the money and give it to me for my residents, so I'm going to do it myself. So Alabama, Alaska, Arizona, Colorado, Louisiana. Louisiana has parishes, a little different, but similar concept. You can think of these states as having states within states. And so Alabama, Alaska Alaska is one of those nomad states, so it doesn't have a state level tax, but local jurisdictions can enact their own compliance requirements. And so you have Anchorage that requires you to collect tax there if you've established physical presence. They don't have a remote seller nexus threshold because they're a local, not a state. But if you have a salesperson in Anchorage, you might have a separate return just to Anchorage itself. Same with these other states where they'll have their own return. They'll have their own rates, their own dates in which they change those. They'll have their own rules separate from the state. And you have your own licenses with them as well. And your own physical and remote seller nexus thresholds. It's just specific for those cities, counties, or special taxing jurisdictions as well within these home rule states. Then we have some situs rules like Texas, where you get the state says 6.25% for the state. Locals are capped at 2%. So total tax to the residents of Texas can only be as high as 8.25%. However, we could have 4 or 5 different local jurisdictions within Texas enacting tax. The county could be 1.25. That only leaves 0.75% left for the city and the metros. Well, might not get to the metros. City might have a 1% tax. Sorry, city, you only get 0.75 of that. So each transaction is unique within Texas because this stacking has to be calculated for each transaction. So if you have the state, 6.25, that one's easy. The locals are the hard ones, obviously, because now I've got that county at 1.25. Okay, which county is that? Great, 1.25. Then the city had a 1% tax, but I only could calculate 0.75. I've got to prove that. And then I have to go onto this Texas state return, which is just a bunch of lines. I have to write in the city, say, hey, I collected this much for the city, and it was an average rate of 0.8 for whatever reason. And then I have to be able to prove it. So that's the burden of the business and of the organization doing business in Texas, is to get this right and never charge a Texas resident more than 8.25%, but also tell the cities what you collected for them and why. All right, so moving on to customer taxability. So I've done all this. I've done my research. I know the jurisdictions. I know the states that I need to collect in. Now I need to know if my customers are even taxable or not. Well, default, everybody's taxable. Yay. Everybody pays tax. It's one of the things you can't get out of, right? Death and taxes. It's one of the things, unless it's not. So there are 2 different reasons why a business could be exempt from paying tax. Those are the main categories, and then there's details underneath. First is who they are. Could be a government entity, and that government entity is non-taxable in that state or local jurisdiction, so they don't tax themselves. Some states, they tax themselves. So if they're using their tax money to pay for something, they'll still tax it. States of California, there's a number of other ones. So that is not a viable exemption certificate within certain states for government entities. But these forms are given by the states. So an organization needs to apply to a state, be approved for that exempt reason, and then given a piece of paper to prove it to their vendors. Okay, that's the different forms of these exemption certificate formats, paper form or digital as well. So typically it's delivered digitally and then printed and filed away. Printed is tricky because it needs to be updated. These certificates can expire. Some of them are lifetime. Typically entity-based certificates are lifetime if approved and given, because that organization would have to change who they are as an organization to no longer be exempt. So some states will give a lifetime exemption for those reasons. Now, digital is easier to manage because you can set rules to say, hey, remind me when this is going to expire. And then you can set up rules to collect new ones as a vendor in that case. Use exemptions are a little trickier because they're for either a specific purchase, be a one-time use certificate. Hey, I'm going to buy this. Certificate is going to cover this purchase only. No other purchases, and then it's toast. Or it could be, I'm a reseller, but that's not an entity. It's not who I am. It's not based on, it could be a could be a for-profit reseller. So me as who I am, I need to pay taxes, I need to pay sales tax, but I'm going to resell this stuff and the state wants it at its higher dollar value. And so if I'm going to resell it, typically I'm going to make money on it. I'm going to resell it at a higher value. And so the state wants that amount of money, which is more than if I paid here. So they're going to approve a reseller certificate. When I buy that stuff, I'm not going to pay tax on it. I'm going to collect that from the people that I sell it to. So that's why I'm going to get a reseller certificate. When I buy stuff, it's tax exempt. When I sell it, though, I'm going to have to collect taxes on that. So those are exemption certificates. They do expire. Some of them do. Like I said, I already talked about lifetime ones. They need to be collected either in paper or digital form. They need to be filled out correctly. They need to be approved by the state, signed, and have all the right correct company information on them to be valid. If found to be valid. These, as the first thing I say on this slide, is the highest potential for financial impact. And this is on the vendor side. If you do not collect this certificate, or if it was filled out incorrectly by your purchaser, the vendor could be liable for all sales tax that should have been collected on that transaction because it's no longer protecting the vendor because it was filled out incorrectly or not valid. So this certificate covers the entirety of the transaction, not just getting a rate wrong, which could be 1%, 2%. Certificate covers the whole thing. And so that's why I say certificates should not be overlooked as an easy process. Yeah, it's just a piece of paper. Make sure you collect it because it could be a pretty big differential during an audit. Remember, audits are only to find differentials, right? It's not inherently bad unless you don't collect a certificate. And that can be bad. 10.4% bad in Seattle, Washington. So that can be a significant hit during an audit. So make sure that exemption certificates are collected, are filled out correctly, and are live during the date of the transaction. Product and service taxability. I'm going to go over this relatively simple. I'm just going to use some examples. This is if stuff is taxable in a state or not. So is it product, physical product, defaults to taxable. Is it a service, defaults to non-taxable. It's nationwide. However, we have some fun details within there. Milky Way versus a Three Musketeers bar. We got Halloween coming up and candy's on my mind. Milky Way bar is prepared with flour. So it's a food in a lot of states because flour, food industry lobbied to get flour to be non-taxable food good. So residents don't pay tax on food. And flour's in the Milky Way bar has flour in it. And so therefore it's exempt. But you buy a Three Musketeers bar, it's a snack. No flour in it. So you're going to pay tax. Very interesting. But you look at it as a consumer, you look at them next to each other on the shelf. One is taxable and one is exempt based off of how they're made. The vendor has to know this and has to be in their system. Price thresholds. We have threshold New York City. Any t-shirt sold under $110 is exempt. Any t-shirt sold over $110 is taxable. So you buy I Heart NY t-shirt on the street in Times Square, you're not going to pay tax on it. Based off of not who you are or what you're using it for, but based off of the t-shirt itself. Services. Basically every service in Washington State is fully taxable. Essentially every service in California is non-taxable, and unless said otherwise within the state. So you get states where services are taxed differently. Okay, these change over time. A lot of updates happen monthly or quarterly. It's a bigger change when an update to taxability occurs. Usually people will know about it. It's a big deal when taxability does change on products, but it does change. Big example of that is digital goods. Digital goods were a non-taxable service when the internet first kind of came around in the mid 90s, late 90s, something in there. It was a new thing, e-commerce, right? Digital delivery of goods. That's not the case today. Most digital goods are taxed as a product. So change does happen. All right, rates. We're finally here. So after all that is already considered and established within the transacting system, rates can apply. Now we got here, this is actually pretty easy. We just need to know all the rates for all 15,000 taxing jurisdictions across the US. Pretty simple. And have it in a table before the transaction occurs. And so these consist of typically an aggregate rate built up of between 3 to 7 different jurisdictions within a single transaction. So those will all build up to the total rate that's applied to the transaction for that customer. Typically, most customers know their rate in their location, or at least close to it. 8.4% here, 10.4% in Seattle. You kind of know what your rates are. The vendor needs to know what jurisdictions make up that rate. Okay, I'm not going to go too much in depth there. The difficulty, though, with rates is here. This is a local jurisdiction within Colorado. It's a suburb of Denver. Zip codes do not build rate tables. Period. End of story. Zip codes are for delivering mail. That's it. That's all they relate to is mail. They are horrible for across most states. Now, given some states are county-based and zip codes will reside within that county, and so they can be used in some county-based states for sales tax. Yes, given. Most states, however, you're going to see this, where you get cities and counties and special taxing jurisdictions bisecting different zip codes in very odd ways. And so zip code will mostly be completely wrong. So zip codes, you might get an average rate and good guess at it. And if you have a high tolerance for risk, this is a great way to go. So zip codes are used for mail, not taxes. And this is an illustration of why. All right. So these excise taxes, tax on tax, I mentioned that already. What is it? Sugary beverage. It's a tax that's applied when sales tax has already been calculated. Gross receipts tax is just, hey, how much did you sell into our jurisdiction for the period? Great. You owe 0.5% of gross receipts. Pretty straightforward. Washington's called B&O tax, business and occupation. Colorado, Minnesota have these delivery fee concepts, which are a fun one, or a bag fee. You go into a retail store, you click on I bought 3 bags. Sometimes that's a tax. Sometimes it's just charged by the store. It totally depends on the state. These delivery fees must be outlined as a separate line item on the receipt. So you see sales tax, and then you have a delivery fee of 29 cents. And that's what these are. So it's a tax, but it's a flat rate. It just needs to be individually outlined on the receipt. So this is more of a technology requirement to get that to display on the receipt as a 29-cent fee. Less difficulty in managing it by state, but it does exist. Telecom is a whole nother story. It's a whole nother webinar, along with the excise taxes, oil and gas, all of the complexities of that. But I'm sure you see them on your cell phone bill. When you stay in a hotel, you see them on the occupancy taxes that are on your receipt. So you see the complexities therein. All right, sales tax return and auto reporting. This is the only place that the state sees what you do. The equivalent to having tires on a car. You can have a 1,000 horsepower engine. If you went and bought bald tires, third party, off of Craigslist Marketplace, your car's not going to go anywhere. So it's only as good as the rubber that hits the road. An overused cliche, sure, but it's true in this case, where if you can't spell the name of your business correctly on the return, you're probably going to see an auditor come in through your door. Bad collection data is bad remittance data. So if all of the steps leading up to the sales tax return were wrong, well, guess what? The return is probably going to be wrong too. It's just what it is. I put on there, it's a thankless activity when performed manually. That kind of comes from the depth of my heart because I filled out sales tax returns for a long time. And this is kind of how I felt, I think. It's more of like my own maybe past coming through in that line. But sales tax returns just are not fun to fill out. They're a requirement. You don't get a promotion for doing it correctly. It's just something that needs to be done. And that's it. And be done correctly. It's a high risk process, low reward process. And so from everything I hear in business school and around, those are the activities that should be automated. When it's a high risk, low reward, high turnover position that's not fun to do, probably a machine should be doing it instead. And so that's what we see here. It needs to be done right, and it needs to be done right every time. And these can be pretty complicated to fill out too. And I apologize if there's anybody on the phone that does fill out returns, and that's just not. Hopefully, I didn't say we were going to automate you out. That's not true. It is. It's not fun to do. I've done it for a long time. Hopefully, I did not offend anybody there, saying that the process you got. There's tools that can assist with it as well. In fact, the Vertex is signature ready returns and things like that. So there's a lot of different tools that can help with the process if it's important to keep in house, which is the case in many organizations. Bringing together multiple business entities, that's a complication that needs to be manually processed, for example. So there's many use cases where a person does need to fill out the return. So I'm going to backpedal on that one a little bit. Apologies if you do fill out returns and that is your job. I've done it. I've been there. I appreciate you. All right. So just to review, what makes up tax is nexus, sourcing, rules, customer taxability, product service taxability. Now we get to the rates. And then we get to any excise or a tax on taxes, bottle tax, etc. And then we have to tell the states what we did, and we have to report that into financials. That has to settle with the ledger, and then we have to tell our internal executive team that everything was done right. And then we need to produce reports if an auditor comes in through the door to tell them what we did and we did it right. And we have to do this all within our tech stack, which is made up of ERP, Salesforce environments such as CPQ, billing, commerce products, B2B, D2C commerce, we have B2C commerce, et cetera, and base CRM as well. We can do that with tax tables. Like I said, Salesforce is fantastic in custom tax tables. They're one of the best solutions out there for being able to create manual processes to manage tax compliance because of the customization of the system. And that process can be enhanced by using a tax engine such as Vertex. And I'm going to go through that pretty quickly here. I don't mean this to be a plug for Vertex. It's going to be more of a knowledge session. So I'm going to go through these slides on technology a little quicker. Commerce and OMS. So I'm going to talk specifically to some Salesforce environments here. Commerce needs to calculate tax correctly, but typically it's a quote. It's an estimate of tax. Okay. So this quote is just legally required to be on the order to say, hey, consumer, you're going to pay about this in tax. And there's going to be a tax, just so you know. And that's pretty much all that needs to be required. Now, in fulfillment, or if payment is stamped during checkout, that changes. It's going to be a committed tax, okay? And it's not going to change if payment is taken during that place order process. Or it's done on fulfillment. That's going to commit that to the states. CPQ, billing, revenue cloud. We can have full webinars based off of just these tech stacks. I love them. The tables need to be built in here, or the tax engine needs to be collected with all of the compliance requirements therein. And then an ERP, same thing. I'm going to skip through this a little bit faster because I've already discussed them. And then social media and marketplaces, we need to know what they collected, so we can report and say, hey, the marketplace collected this amount on our behalf and remitted it already. So what is a tax engine? Well, the tax engine is, manual tables. We all kind of know what manual tables are. We put the rates in there. We build the rule sets of what's taxable, what's not taxable. It has to be updated by an internal employee. It's perfect for about under a 10 state nexus. Over 10 state nexus, it gets to be a large burden of managing those tables. Okay, just as based off of the compliance requirements, not the system, it gets to be a burden with changes, rate updates, rule updates, boundary changes, things like that. High level of control, high level of indirect costs, low level of efficiency and accuracy. Tax engine offshores that requirement to a vendor such as Vertex, to where we already have all the rates. We already have all the rules. We have the boundaries. All you need to do is tie to them. You need to tell the engine what you're selling and what it relates to within our rule sets. And then that's taken care of on every transaction moving forward. That tax requirement is offshored to a specific system that is built for handling tax and has a lot of that legwork already done. It's high level of control still. We can create custom rule sets, custom rates. If there's any specific requirements that need to be met, those can be built into this tax engine. It's a low level of indirect cost. And there's a higher level of direct cost, right? Because you're paying now a vendor to handle it for you. But the indirect cost drops. But there's a high level of efficiency and accuracy. There's also some risk abatement in there as well. There are certain things that tax vendors will take the responsibility for, like making sure that the rates are correct if tied to correctly. It's kind of a mutual risk abatement. Custom systems and processes sometimes need a custom solution. I've sold many AS400 system solutions. I used to use AS400 retail environment, and those require custom connectors. They can be done though. All right, a little bit about Vertex. I'm running a little long-winded here today, so I'll wrap this up. Vertex, been in the business for 40 years. We used to send books of rates before technology was around. It was a pamphlet. We used to send updated sheets of rates across the country. That was a fun time. And then after that, we had CDs. We would mail CDs for people to update their mainframes with. We'd have all the data on the CD. Now we have cloud solutions. We have on-premise solutions. We have hosted deployments. We have edge containers for data residency, and if the country requires it. Lots of different technological solutions in existence today. We have been a partner with Salesforce for quite some time. We are actually the #1 revenue producing tax partner of Salesforce. Proud to be that. And there we are. It's a great solution for Salesforce. We've been a partner with them for a long time. We are closely connected. We have powerful end-to-end solutions built on the Salesforce platform. We handle registrations, product mapping within Salesforce. So the goal of using a tax engine within Salesforce environments, such as commerce, all the commerce products that exist under the Commerce Cloud. We have Revenue Cloud, historical Revenue Cloud, which is CPQ and billing and subscription management. We also have the new Revenue Cloud product with a connector to that, where things now are simple to calculate tax. We take the complexity of all of that stuff I just outlined, the tax tables, the rates, the fantastic customization of Salesforce to handle that. And if you have a lot of states to manage, what we do is we take that, put it in tax engine, and we make it extremely simple upfront, meaning nobody wants to have to dive in there and check that the rate is right. Let the salespeople sell, knowing that tax is done correctly. Okay. So we do this by incorporating all aspects of the compliance journey that I went over: tax determination, rules, rates, seller reporting, filing and remittance requirements, validation of business IDs, making sure that the business on the exemption certificate is who they say they are, and that certificate is valid in that state. We validate certificates. We validate business IDs. Invoicing. So for e-invoicing in Europe, I will touch on this. There are countries coming up with invoicing requirements that are heavy. It's e-invoicing, Brazil, Italy, and there's one other country that I forget off the top of my head right away, but more are coming down the pipe that have specific invoicing requirements. Well, Vertex can handle the specific look and feel and delivery of country-specific invoices. Then there's marketplace liability as well. I won't go into on this webinar. It's a whole nother complexity. So here is an illustration of our connectors into Salesforce. As we can see, commerce is on the right. E-commerce is a complexity because rates have to be in there before any individual within any state can transact. You cannot look it up after they said they want to buy. It has to already be in that system. That is the difficulty with e-commerce platforms and taxes, is you have to build every possible grouping of jurisdictions in that state, because any single resident in a state could transact on your website at any given time with no preparation. So every single combination of tax jurisdictions must be already built into the system before opening it up to residents of that state. We have CPQ, billing, subscription management, and like I said, Revenue Cloud as well. We also have a connector to core CRM. This is for quotes within opportunities. Some of our customers require a quote to have tax on it. Government entities, higher ed, organizations paying with tax need to see that. Alrighty, I have a short demo video for everybody here. I'm sure you're love hearing my voice, but you'll hear it again in a recorded fashion. Just a second here. Let me do my screen share. Window. Okay. This is a quick demonstration of Vertex tax calculation within Revenue Lifecycle Management, or what's called now Revenue Cloud. First, create a new quote, and then attach this quote to an account. Then add address information. Here we see the new quote. Click Browse Catalogs and select the products that you want to sell. Those products are going to be added to the quote, and here you'll automatically get tax calculated. Any changes to the quote will reflect a new tax calculation as well. Here we see tax updated. Now we're going to convert this quote to an order. Once the process is completed, open the order. Same concepts apply here. Any changes made to the order will automatically reflect tax. To access the Vertex app, go into App Launcher. And in this demo, it's all the way at the bottom. Click in Vertex. Go to Vertex Configurations and Settings. This is where you're going to find all logs of tax callouts made. Dive into a log. And here you can see the details of the request and the response. That's it. All right, everybody. Hopefully you were able to see that video and see a quick little demonstration of how Tax Engine, when set up correctly, can handle taxes seamlessly within Revenue Cloud at Salesforce. All righty. So when do organizations seek a tax solution? Well, typically this is a new technology purchase or innovation program, legal changes, you get audited, staff changes, there's expansion or growth into new industries, different business units, or the creation of a new market, right? So this is typically there's catalyst of some kind to review and assess whether a tax engine would be a good fit. All right, so finishing up the webinar here, I want to leave a little bit of time for questions at the end. Where do you find Vertex? So Vertex, we have a single listing in AppExchange. There is no downloadable software available through this AppExchange listing, unlike a lot of other listings and software ISVs that do reside in AppExchange. We have 10. We have 10 different connectors to different systems. So we really need to understand what systems our clients use to connect that tax side to the technology side. So that's why we don't offer any of our connectors for automatic download within AppExchange. But you can find it here, and you can find more information, more demo videos, more information on who Vertex is, why we do what we do, how we do it, and what our relationship is like with Salesforce as well. Some more details in that regard. Who is the team here at Vertex that supports Salesforce as a partner? I'm not alone, and I love it because there's no way I can handle all this on my own. Salesforce is a fantastic partner in that we stay busy. We stay very busy. And so this is my direct team. Erin Kissling is the global partnership director with Salesforce. Lindsay is my counterpart. She also runs the partnership. And then Alyssa is the channel sales manager. So she works with a lot of the AEs there at Salesforce and also the SI partners across the country and making sure that they have assistance from our team if needed. And then Tula is our product marketing manager. And then the team extended support below is all of our marketing, sales, and all of our sales reps at Vertex can sell Salesforce integrations. but these are direct assistance to the pod as well. We call it a pod. And with that, I am 1 minute over my question time. Shoot, I thought I was aiming good there, but overshot a little bit.
Yeah, no worries. Yeah, so really interesting presentation, Scott. About as complicated as I expected, and I'm not alone. There's a comment in Q&A from Paul saying, so complex, and I bet we're barely scratching the surface of these tax codes too. So first question here from Ryan, who's wondering, is there ever a case in which the economic nexus rules of a state may be looser than that of a local jurisdiction in that state?
A specific example I cannot think of.
Okay.
However, it's possible. It is absolutely possible. Some of these local jurisdictions, especially in home rule states, where they have separate and distinct compliance requirements, they're very aggressive. They can be. And so it would not surprise me if they established a more difficult, if the local had a more difficult economic seller, remote seller threshold or rules associated with it. Now, that said, locals have not adopted the economic/remote seller nexus rules as quickly as the states did. The states, almost within 6 months, almost every state had enacted. It's amazing how quickly laws can get passed when there's a lot of money involved. All the states were just chomping at the bit to pass something like this. They were just waiting for somebody to take up the case. Locals, a little slower on the uptake. Locals have really leaned on the physical presence requirement.
Okay, great. There's a question here. From your perspective, if we're going to add a tax solution, which Salesforce product would you recommend starting with first?
Ooh, that's a great question. Because from my experience, a typical user of Salesforce doesn't just use one product in the Salesforce ecosystem. It is a fantastic platform in that things work together better within the Salesforce platform than using external vendors to kind of cobble some solution together. So typically there's multiple solutions that will transact within a single Salesforce kind of tech stack. Okay. My answer to that is, from my kind of tax-centric perspective, is all of them simultaneously if it transacts. Remember, I started this webinar saying tax needs to be calculated everywhere that a transaction occurs. And that is true. And it does need to happen because it's a workflow. Transaction needs to be calculated up front, especially on a commerce B2B solution. And then if it goes to OMS, it needs to be calculated again because that's fulfillment. And then it needs to settle within an ERP that could handle returns. I hope you can't hear. I have some noise outside my window right now, but hopefully you can't hear that. Yeah. Okay, thank you. So I would say simultaneously. Now, it's going to depend on where the need truly lies, to which system to tackle first. The connector side, I will say, is easier to install the connector software to make that call and display the tax than setting up the compliance itself. Typically, the compliance within a Vertex account is the biggest task for getting that all set up. Once that's done, the connectors are simply just spokes in a wheel. Compliance is the hub, and we just point to the different systems that need that tax calculation made. Okay.
Well, Scott, it looks like we're almost up on time, but the last item in the agenda was, telling people how to get started with Vertex. What do you recommend?
I recommend going onto the Vertex website, going to App Exchange, learn who we are, see the videos. That would be the first step. Second step is get your team aligned before you make a call to Vertex. Because what we're going to do is we're going to have a discovery meeting with you to learn about your sales tax compliance needs, but also your Salesforce technology needs as well, or other systems that might be outside of Salesforce that might need a calculation. But my focus is Salesforce, of course. I'm a little biased. But that'll be the first step. Get your team rounded up together, everybody aligned. Get your sales tax scenario outlined, your tech stack outlined, and then you can get a hold of me. You can get a hold of Vertex just by calling in. Lots of different ways to get a hold of us, or contact your Salesforce AE, and they will loop us in as well.
Okay, fantastic. Well, Scott, thank you so much for putting together a really informative presentation today and all these insights in the Q&A. Really appreciate your time today.
Absolutely. Thank you, Scott.
All right. Well, I'm going to let Scott go there, and we've got one last piece of business, and that is the Amazon gift card prize drawing. And the winner of the $250 Amazon gift card today is Stephen Bezra from Massachusetts. So congratulations to Steve Bezra. We'll be in touch to get you your card. And with that, on behalf of the Smart Brief team, I want to thank Vertex and Salesforce for making this event possible. And thanks as always for attending and for your great questions. That's going to conclude today's event. Have a fantastic rest of your day.